massive turn of events on a day-to-day basis. And again, at the epicenter of all of this is the worries about peripheral Eurozone debt, Italy being downgraded, of course, today. Interesting comments from Fed Chairman Ben Bernanke yesterday. How does one muddle through all this rhetoric on a day-to-day basis to come up with a strong assumption in terms of where we could be going from not only a fixed income perspective, but just general markets perspective?
Yeah, Eleni, I think recently I said to you right at the very end of our interview that one needs a very strong stomach for this market. It's clear that you need a thick skin now as well. The intraday volatility and the intra-week volatility is really reaching silly levels, and it's always important to remember those very old trading rules when you're still young and fresh on a dealing desk, that it's normally when market fatigue sets in that big things starts happening. So that's not necessarily an indication of what's about to happen, but it's normally a good early warning signal that something's about to change.
Well, Erik, at this point, it seems that we keep talking and banting about whether Greece is going to default or not to default. What is the market telling us right now? The US Treasury yields, of course, we know that there's been quite a bit of intervention. The Fed selling short-term bonds and buying long-term bonds. It's really difficult to tell with all the intervention that we've seen on a global level.
Yeah, I think that's a very fair comment. I thought it was quite interesting last night that Bernanke in the Q&A session basically admitted that he's not expecting much more than a 20 basis point benefit from Operation Twist. So, you know, it's really one of those buy the rumor, sell the facts things again. And I think what you've seen in US Treasuries in particular in the short term is just this flight to safety. So you would have seen the biggest bond funds in the world having gone short Treasuries up at the 2.5–3% level, now being invested to the tune of 15 to 20% again in these assets. That's obviously also having a short-term impact, but I think as soon as the flight to safety theme fades and we get some better news out from decision makers in Europe and US, you're probably going to see some yield backup in G7 and cash being redeployed in risky markets or higher yielding assets.
Well, put it into perspective for us with regards to the liquidity scenario that is playing out, because, you know, a couple of weeks ago we saw the biggest selling out of South African bonds in the history of the market, essentially. We're starting to see gold coming under pressure, for example, and it seems it's not because there is lack of fear in the market, but just because we're starting to see investors selling across the board to cover losses elsewhere. Is that the right assumption to make?
100% correct, Eleni. I think what we've seen over the last month is especially foreign houses referring to local currency investments suffering because of dollar strength. And we've seen that in particular in the local currency debt market space, where we've had record outflows at the end of last week, if you look at the EPRF data. And I think that is really a theme of, in the short term, too much cash have flown into emerging market local debts. But I think the theme that we've been speaking on this show for a good 3–4 years now, that the glacial shift from, you know, that asset allocation shift from developed market or ex-growth markets into pro-growth markets, that theme is not going to go away. It's more a short-term phenomenon where you see expatriation and profit taking or flight to safety. But remember, at 0 to 1% interest rates, cash is burning a big hole in investors' pockets offshore.
With regards to what could be happening behind the scenes at this point, Erik, you know, at Jackson Hole meeting, you know, a couple of months ago, we heard a slightly more positive rhetoric coming through from Fed Chairman Ben Bernanke, things changing quite extensively, just hearing what some of the commentary was yesterday. Again, you know, the EU a few months ago wouldn't even entertain talk of a default, and now it seems that that could possibly be on the cards. There's a lot of political, there's a political aspect that is playing out here, and I'm sure that it puts investors in a very tough position to actually tell truth from fiction.
It's extremely frustrating, to say the least. And I think what it would appear is happening at the moment is Europe is buying time to understand exactly what it would involve to let's call it orderly default in Greece. And, you know, whether that means that Greece should be put aside and outside the EU, I'm not sure. Merkel, just before I walked into the studio now, Merkel said again that she believes that Greece should stay in the EU, and that there's going to be support, on the banking side as well. So, every single day we get a different comment from a different person. My assessment of the situation is that in the European zone, they're buying time to figure out how to ring fence the problem children. And that means we're going to see some more can kicking down the road exercises being implemented for the next few weeks. Maybe I think the G20 meeting it's November is probably going to be the key one to watch out for.
With regards to Dexia, it's something that has been on the cards for a few weeks now, the company coming under significant pressure. Of course, it's a French-Belgian bank, and it seems that one of the reasons that it is taking such a big knock is because it's got such strong and big exposure to Greek debt. Is this the real reason, or is there something that is playing underneath a lot of the headlines that we've seen?
Yeah, Eleni, it's really just part of a much bigger theme. Our CIO, Arno Lorenz, have been running with a presentation for a good 2 years where he refers to the web of deceit. And if you just look at the cross holdings of banks to banks and sovereigns to sovereigns, etc., it's actually frightening, to say the least. And I think that's why you have the likes of Tim Geithner rushing over to Europe to kind of, be part of the discussion and kind of assist and give advice. This is a big house of cards, and if you pull the wrong card, it can get very, very messy. So I think the Dexia situation, while it's a big theme, I'm really not liking what I'm hearing there. It's got a very much a Bear Stearns ring to it in terms of the idea that's being put forward there. But I think the Dexia story now shows that we're at the epicenter now of the European crisis. And, Belgium was a story, let's go maybe back a year or two, where people started getting very worried about Belgium, and now you're really seeing some of the signs, proving to be true.
Erik, the medium-term budget policy statements coming to the fore soon. I cannot believe that it's already that time of the year. What kind of numbers are you expecting? Is there anything in particular that you'll be looking out for this time around?
Look, we don't hard forecast, but I think what's very interesting is over the past few days, we've had both the finance minister and the deputy finance minister making interesting comments with regards to the growth outlook and the debt situation of the country. The overlay to that, of course, is also that on Monday, by complete surprise to us at least, and it seems to the sell side as well, National Treasury announced a 33% increase in inflation-linked bond issuance at its weekly auctions. So today we had the announcement of the nominal bond auction for next week. So the issuance size for that stays the same, but it does feel like the runway is being cleared for different downside growth revisions, and I think that should be in the price. The extent of those downward revisions we're not sure of. It's unlikely that the MTBPS addresses the issuance debate. That's normally left for the budget. But in this type of environment, we should be careful to exclude these things as a non-go. And I think if you look at the yield curve, people are concerned that if we don't see foreign sponsorship of the local debt market anymore, it's going to be questionable, this whole developmental state debate and fiscal space and fiscal expansion. Who's going to be continuing buying the back end of the bond market.